So rightfully so, a lot of people are worried about what's going to happen to the stock market once student loan repayments begin again. And Barclays thankfully put together a phenomenal piece on their estimate. Bear in mind, it's their estimate of what is going to happen to the economy and which stocks are going to benefit or fail based on the student loan repayment re-beginning. So we're going to talk specifically about that by going through the Barclays piece. This is, by the way, well, I just want to say, by the way, I'm grateful to be coming to you from Canada. I don't think I've mentioned it yet, but well, obviously, many of you know I've been on vacation in Canada for about the last 11 days with family, and my goal is to still bring quality content to everyone. And so I appreciate all of your support while I've been out here with family, and we'll be back soon. So, anyway, back to Barclays, or to Barclays. What do we have here? Pencils down, payments up. Student loan repayments impact. Ooh, juicy. We estimate the aggregate potential, total potential hit to from student loan repayments to be somewhere around $15.8 billion of a monthly headwind. And that will likely work out to an incremental payment spend of about $390 per person starting this fall, which is about an 8% headwind to monthly personal income. Now, what we're going to do is we're going to go into some specific stocks that this might affect. And I want you to start thinking about, okay, what kind of person, what kind of spender is most likely to be affected? And initially, I had this impression that, oh, well, of course, people with less money are going to be more affected by student loans. But you have to ask yourself, wait a minute, but people in a certain level of poverty don't actually have student loans to begin with. So there's this interesting middle ground that we're going to be paying attention to, and stocks associated with that middle ground. And I'll add my commentary, of course, on that. But anyway, let's take a look at this. The expectation here from Barclays is that we're likely to see discretionary spend fall by an equal amount of this decline in monthly payments, or this increase in monthly payments people are going to make. So, for example, if you see people have $390 less available for spending, you'll probably see nearly all of that show up as less spending. So, in other words, now people, instead of spending $390 a month on Etsy, are potentially spending it on student loans. Instead of spending it at restaurants, are spending it on student loans. Instead of spending it, whatever, at Target, they're spending it on student loans. Obviously, to some extent, people are still going to spend money on their staples. This would be the discretionary money. This is your toys, your video games, your Dave and Buster's, your entertainment, your travel, your airfares, your hotels, everything. Because remember, what people generally do is they save up for travel, right? You save up 3 months, you got $1,000, and then you go blow it on Disney tickets for the weekend or whatever, which is the point of life anyway. It's like, we work to have fun, and we work to provide fulfillment and the meaning of success to our lives as we provide value to society and our friends and family and the companies around us. And then we also want to balance that by having fun and entertainment. So this is very normal. But consider these things. So anyway, uh, so here's how they come up with their calculation of about this 8% headwind to monthly spend. But take a look at this. I think this is very interesting because they get into some stock implications here. In our view, consumer discretionary and apparel categories are likely to be among the areas affected by incremental wallet pressure. Okay, incremental wallet pressure. In English, it means they have $390 less to spend. Furthermore, we view that equities are among the most likely to be affected, or the equities to be most likely to be affected, are those that have a customer base that skews, look at this, folks. I was actually surprised by this, toward higher income, higher education consumers. So think about it. Your white collar consulting students, your nurse students, your doctor students, your mechanical engineers, electrical engineers, your people who are making six-figure salaries but potentially are still living paycheck to paycheck. It's reportedly CNBC at least did a survey on this. 50% of those who make more than $100,000 a year still live paycheck to paycheck. That's probably the base you're talking about. So to some extent, does that mean maybe you're talking about your Lululemons, those tight pants, Yes, your Under Armours, your Lululemons, your Urban Outfitters, your AEO, your Figs. Remember, Figs was a huge fad there for a moment. Figs, like nursing and doctors, scrubs or whatever. Okay. In the first bucket, we perceive and they have three risk buckets. In the first bucket, they think the greatest risk to retailers is targeting recently graduated or newly employed. That's because they likely have the lowest built up excess savings. And so that would be your 18 to 34-year-old range. I do think it's interesting that they include 18-year-olds in this, since I don't know a lot of 18-year-olds graduating from college. So I would probably be looking more at like your 22 to 34-year-old range. This is your, finding yourself age, you're more critical, you're more skeptical, you're more wise age group than obviously like a 14 to 20, right? It is, but it's also your age group that's more willing to also spend, because we realize we're not just here to work. Anyway, to some extent, Tesla is within this bucket, right? 25 to 34, 25 to 45-ish-year-old males make up like 70% of car purchases from Tesla. So that's probably in that bucket. And honestly, $390 a month is about half of a Tesla car payment. Anyway, we categorize exposure to student loan debt repayment risk in three main buckets. The first is the recently graduated and newly employed. In the second bucket, we consider a higher target income, like the aspirational luxury category. Okay, your fancy pants. This is your fancy pants category, including, you can see some of the tickers on screen here: CPRI, TPR, Goose, JWN, your Lulus, your Ulta. Ulta has been on a tear. So anything that says Ulta might actually become affordable again as a stock, maybe is a good thing. But anyway, in the third bucket, we see the least risk, the lowest risk. And this would be a customer base that skews towards lower income or lower educational levels. This is going to be your Gap, your TJ Maxx, your Old Navy, Burlington Coat Factory, whatever. So your lower income actually at lower risk from discretionary pain, where it's really that, yeah, there's Lulu. It's really your Lulus, your Fakes, right? Your Urban Outfitters. Who knows? Maybe even your, what's that one place that Lauren likes so much? Anthropologies, that sort of segment. Yeah, they're going to get hit a little more. I wonder what that's going to do also, thinking about it, to your home decor market, to your Chip and Joanna Gaines inspired younger couples who are like, I gotta buy shiplap and new furniture, and we gotta have a new vintage looking oven, and all that kind of stuff. So maybe to some extent a little bit of everything. Yeah, there'll be a limit, I expect, to make up. But anyway, that's actually just the piece here on student loans. It's just this segment here, but I think that actually gives us a lot of color on student loans. So I would pay attention to this and look into some of the discretionary categories that have done very well, but do also consider a comparison between some of the companies that I've mentioned here and something like an Etsy, specifically just on stock performance. So let's for example look here. Let's jump over to Webull, our favorite desktop app for looking at stocks. And it's also a pretty good mobile app. And Tesla went green in the pre-market. How funny. But anyway, remember, you can get yourself 12 free stocks by signing up for Webull by going to metkevin.com/free. Metkevin.com/free, or check out the links down below. Paid promotion with Webull. Anyway, okay, so let's just, from a technical point of view, let's just go solely technical here. So let's look at something like Etsy. And why don't we jump on over to let's go to a week chart on Etsy. Okay, so this is Etsy on a week chart. So from a technical point of view, you've already experienced a substantial amount of pain over here at Etsy, and there's a limit to how much I think Etsy can really get hit more in this discretionary pain, specifically because they've already been hit so hard. And I think that probably creates more of an opportunity than it does a deficit. So I'm watching Etsy very closely. Let me throw over my StreamYard overlay. By the way, since I'm live streaming from Canada, I'm grateful to StreamYard, metkevin.com/StreamYard, for providing the ability to throw up banners and share screens and stuff. StreamYard's fantastic. Just go to metkevin.com/StreamYard to learn more. Oh, okay. So now let's look at like a Lulu, right? Let's look at some of these other tickers mentioned here. This is your Lulu here on a week chart. And you could see Lulu's really been, you could almost say range bound. I mean, we could, to some extent, we can go with some horizontal lines here, and we could somewhat set up Lulu as range bound. Yeah, there we go. It's not perfect, but you could really see how Lulu's been holding up. And a stock that I saw that was range bound for a while that didn't get punished yet was Ubiquity. And you could see Ubiquity was range bound over here, really between this 325 and 284 level. It was range bound for about 2 years. It just couldn't break out. It refused to stay lower until it finally tanked. This is my buy point right here on Ubiquity. And so I've actually actively been increasing my personal exposure to Ubiquity because of this. But we look at something like Etsy. Seems like it's already had some of its pain. But then you look at a Lulu. You haven't really had that correction yet on Lulu. Is it possible that the student loan issue happens to Lulu? Yes. Now, what about like an Ulta? Boy, this has been one of those rough ones where it's like if you haven't been in Ulta, you're like, man, I wish I'd been in Ulta. Because this is the week chart for Ulta. And you can see here's the COVID low right here. It's basically been straight up. I mean, you could really just go in here and draw a trend line support and go, who cares? They've had a recent correction. This stock is straight up and it ain't going anywhere. And maybe that's true. Or what's actually more likely to be true is if that COVID, or rather the student loan repayment, begins again, and we do end up seeing some pressure to Ulta's growth, which Ulta is built on a lot of growth right now. You look at Ulta, I mean, even from a PE ratio, let me pull up the latest PEG ratio on Ulta. But my latest recollection is that Ulta's growth was actually pretty lofty, not to be confused with the company called Loft. But anyway, lofty valuation and really relying on growth. So if you have something that could take away even just the marginal growth and write down growth at Ulta, you could see more of what you saw on the right side there, which was a correction down, but it's still only just a temporary, I mean, still a range bound correction. We could actually break out of this range, would be the concern. So let's see here. You're sitting at about an EPS on Ulta of a January 2024 of 25.36. So we're going to divide that by 447 divided by 25.36. That gives us a PE ratio of 17.6. Now you might say, "Hey Kevin, that doesn't sound so high. Why is that bad?" Well, what's bad is they're only expected to grow their earnings by about 6%. That puts you at a PEG ratio of nearly 3 for Ulta. So on a price to earnings growth basis, it's very high. So these are some considerations when it comes to student loans and what we might end up seeing with student loan repayments and some of the pain. MC Hammer thought the money would keep coming in. Yes, yes, exactly. Lifestyle creep. Yes, there's a lot of that. A lot of famous wealthy people who went bankrupt just spending too much. But anyway, these are some things to consider. If you like my perspectives, again, check out the programs linked down below on building your wealth. We've got some massive new lecture sets coming out soon, and we'll have some large price increases again as we get closer there. So join the programs down below and email us at staff@meetkevin.com if you have any bundle up considerations or questions about the programs. Staff@meetkevin.com.